Opendoor stock big problem. How big is it? Should we be worried? Welcome to World Traveling Millionaire Stock Investor and Option Trader channel. Where are you watching from? Comment down below. It's up 4.71%. Year to date it's up 493%. So over 6 times. Still have Opendoor call options. I haven't sold them yet. This one 2000 profits, 585% return. So it's over around 7 times the money. 1.13, then now 7.75. So all we need is just a few $100s. Look at this. One call option represent 100 shares. So we multiply with 100, so $113. That's what I use. Now 7.75. So 775. So I still have this call options expire on January 15, 2027. 4,991 market value, up 511%. So it's over 6 times the amount of my money. 4,000 plus return. So only 1.17 when I bought it. Now 7.13. Another one, yeah, 1.39, 6.65 now. So over 378% return. So over close to 5 times my money, original capital. Okay. This one, 227% return, 3,000 profit. It was 1.96, now 6.4. So if you combine everything, right now iPhone 17 came out. Most people are gonna buy iPhone rather than buying the stock. So a better strategy is to buy stocks or call options. Then you use that profit to buy iPhone, right? When you are buying iPhone, you are just giving your money away. The moment you buy it, the iPhone loses the value, right? You sell it, you lost a few $100 straight, a few percent, maybe 10%, 20%, 30%, straight away, you already lost it. But if you put the money in, hey, you get so much return. So right now, just for the call options, I have 15,000. I only spent a few thousand. So really good, really good. So but Opendoor store has one big problem. That could potentially crash the stock. How big is it? That's why we're gonna watch this interview. Opendoor key Rabois chairman.
Adding to its incredible year-to-date rally this week, jumping nearly 80% just yesterday after announcing a C-suite shuffle, including a new CEO and a new chairman. Shares are up more than 500% this year. Joining us now is the company's co-founder and new chairman, Keith Rabois. He's also a managing director at Khosla Ventures. Keith, this is such an interesting story. Obviously, this is the meme stock du jour. How did you get here? How did you come back? Co-founded the company, went public, started during the SPAC phase, was kind of left for dead, and now it's all that everyone's talking about. How did you come back to it?
I think it's very simple. Retail investors figured out the potential of the company. Experts, Wall Street experts, etc., missed the potential. Residential real estate in the world is about a $289 trillion asset, and nobody has transformed the buying and selling of real estate in the world. And Opendoor has the most likely shot on goal of fixing the transaction, both from the buy side and the sell side. So the potential of the company is infinite, and it took people like Eric Jackson, the activist investor, and normal American consumers to see that one way or the other, we're going to transform the way people buy and sell houses, and that company should be worth a lot of money. Many people compare us to Carvana. I used to compare us publicly, on Twitter and X, to Carvana. I think the multiple of Opendoor should be comparable to Carvana. I think we have less competition and more upside. So I think hopefully we do better than Carvana, but that comparison easily gets you to where you are today.
I get the.
Of course, he talked about $289 trillion market in the world. So basically, they are thinking about expanding internationally. So that's why he said it's infinite, the potential, but it's just potential. Okay, so he compared Basically, people compare Opendoor to Carvana because Carvana store went up like crazy, right? But remember, Carvana, yeah, they buy and sell cars. Okay, the margin is also small, just like Opendoor, but they have a high profit margin business as well, which is the loans, financing the loans. So people buy cars, they use Carvana finances, so they make so much money on the loans as well. So Opendoor, they should also have high margin business as well, right? If not, Opendoor may not be the next Carvana. What do you think?
Comparison given where the stock was trading and how it's now beloved and has really turned around. But Keith, wasn't this always the promise of Opendoor that it was going to transform the real estate market? And then iBuying really became out of vogue. Redfin exited it, Zillow exited it, and that was the business model here.
It was never out of vogue. It was out of vogue because Redfin and Zillow didn't know how to do it. We were always successful. We minted free cash flow every year I was involved in the company. However, it's very complicated and very difficult to do iBuying well. But the value proposition of certainty, transactional speed is incredibly compelling to Americans. If you list your home for sale, you are going to wait 80 to 100 days, and 20% of the transactions that you think you've closed are never going to close. We give you certainty, peace of mind, convenience. That value proposition, we just need more awareness. In many markets, we have a double-digit market share, actually. It took Tesla until 2023 to get to a 5% market share in the United States. In many, many U.S. markets, we were above 5% last time I was involved in the company.
So the lady was asking him, isn't it always an Opendoor purpose, to basically dominate the iBuying, but the iBuying has not taken off. And he said, Rabois said it's because Redfin and Zillow didn't know how to do it well, but Opendoor has been able to do it successfully. And what is the value proposition? Basically, certainty, speed, and convenience. One typical seller want to sell their homes, he's not certain, right? If I'm going to sell the home with a real estate, I used to be a realtor, so anything can happen. It could take 30 days, 60 days, 90 days, but when I sold houses, it's always less than 30 days. That's my value proposition as a realtor. 99% of the houses that I sold is less than 30 days. That's why people hire me just like this. And of course, there are lots of realtor and lots of homes on the market. It could be because home seller wants to price it too high, or home seller don't want to, decorate the house, fix the house. There are so many things that could put the house on the market for more than 90 days. Anything can happen. Opendoor come in, hey, you know what? Just sell your house to us. You're gonna be sure that we're gonna buy home. When do you want to move? 1 week? Yeah, sure. Don't worry, we're gonna pay cash. So there is no uncertainty, right? Because you don't even have to worry about buyers financing going through, basically not successful. And you don't need to worry about the time. It could, sometimes the financing could take 30 days, 45 days, 60 days. If it doesn't go through, then you need to find another buyer. So the uncertainty costs a lot. If you're paying mortgage, $3,000 mortgage every month, if it takes more than 90 days to sell your homes, you are already paying $10,000. You might as well sell it to Opendoor. Opendoor probably take the cut about $10,000, whatever, depending on the value of the house. Then at least you get a sanity. Plus you get a speed. When do you want to move? 2 weeks, all right. 1 week, totally okay. Okay, so that's my experience with Opendoor as well. And of course, most of the clients sell it with me because they know that they can sell it within 30 days and they get more money on the Opendoor. But majority of the real estate market is not like that. Okay, so that's why some of them they go with Opendoor. Plus, after sanity, speed, then after that, convenience. You only need to talk to Opendoor. Opendoor doesn't ask you to fix anything at all. That's based on my experience. So that value proposition, if more people know about that, people may give Opendoor a shot, yeah. But the thing is that not a lot of sellers go to Opendoor because their offer could be really low. Yeah, could be low. That's what they want to try with agents. And so Opendoor needs to come out with some other low margins, higher margin, because when they sell houses, they need to borrow money. And plus, when they sell the house, the margin may not be that great. Okay, so what could be the big issue that he wants to talk about?
Yeah, but wasn't always the thing that once the housing market turned, then the company was stuck with a lot of mispriced inventory. That it didn't work so well when the housing market was weak.
That's actually false. So the Federal Reserve raised interest rates 6 times with unprecedented speed, and that did create a cohort, i.e. one cohort, 1 month to maybe a quarter, of mispriced homes. However, every cohort thereafter was actually priced correctly. The problem with the company was bloated G&A. So real estate does have a roller coaster ride to it. There are phases, cycles, and they happen every 5 to 10 years, and you need a resilient cost structure that doesn't depend upon selling 6 million homes a year, because it can come down to 4 million. That's basically the zone over the last 30 years. And so the bloated G&A was a real problem, because as people stopped transacting, as interest rates went through the roof, the company's G&A made no sense, and so the burn rate made no sense. But you can fix that. There's 1,400 employees at Opendoor. I don't know what most of them do. We don't need more than 200 of them. It's got easier because of the advent of AI and other technologies. This will be a simple problem. One of the reasons why we were so excited to recruit Kaz actually as CEO is when he took over as COO of Shopify, I believe G&A's expensive revenue at Shopify was 14% last year, or this year. I think it'll be 4%, and I'm pretty sure they'll be below that next year. So we need to do the same. We need to have the same discipline and rigor in Opendoor. And then when real estate bubbles when they go up, we'll make an incredible amount of money. And when people stop transacting, meaning they only sell 3 or 4 million a year, we won't care, because we're still going to be profitable.
Right. The big issue is SG&A. Sales, general and administrative, usually the fixed cost. So because of fixed cost, they have to sell 6 million homes, right, to be a little bit, have some margins. If it's 4 million, if the real estate market, something happens, if it comes down to 4 million, they will have big problems, because they have a bloated SG&A cost expense. Now the new CEO they hire from Shopify, he was able to reduce from 14% to 4%, right? So that's why he hired. That's one of the main purposes of hiring him. So if you are working at Opendoor, just be prepared to get fired, right? Start looking for a new job now, because they have over 1,400 employees. They want to keep it only 200, and they're gonna rely on AI, which is good news for investors like us, right? Investor traders, whatever, like us. If you can only do with 200 employees, and you use AI to maximize revenue, maximize profits or cash flow, that will be perfect.
It's interesting you hinted at cost cuts and the fact that there are a lot of employees, and that there's probably a lot of room for cuts, because that's been the other knock on this, is that it was hard to make this a profitable business. The margins were very thin, and for this year, I think we talked to an analyst who is expecting continued losses.
Well, I haven't yet dug into the financials. Kaz hasn't started until Monday morning. So when we dive into the financials, I suspect we'll have visibility, and we're going to innovate. We're definitely going to not take the forecast as a given. So I won't opine about the future, financial future, et cetera. I know the strategy. I have a high level view of the strategy of things that can be improved. But there's no way you need 1,400 employees. So he's right. The company is completely bloated. The culture was broken. These people were working remotely. That doesn't work. This company was founded on the principle of innovation and working together in person. We're going to return to our roots. We have a mission. You should read Kaz's post. It's a brilliant mission about how home ownership drives society. And the society is only good when people have home ownership. We need to fix that, improve that, make it more affordable. And, the company kind of went down this DEI path. It still, was promoting certain things on its website when I got re-involved. We're going to fix all that. We're back to merit and excellence.
Hey,
So
stop.
it will be pretty interesting to see Opendoor transform with a new CEO. And remember, hey, people are walking away off the office, so now they're gonna bring everybody back. They're gonna reduce their SG&A, and let's go and look at their SG&A. How big is it? How close they could be successful at implementing their goals. So let's go look at this one, SG&A. Okay, this is the 3 months ended. Just look at the operating expenses. From March 31st, 2025 to June 30, 2025, 3 months, 155 to 141. Yeah, they have been able to reduce that. And compared to last year, June 30, 2024, 201, 141. Pretty good job. 6 months ended 402 to 296 million. So we gotta look at the December. Okay, December. See 2024, 179, 155. Yeah, so the trend is going down. Hey, I'm happy to see that. Okay, the trend is going down. Plus, the revenue is basically here 1153 to 1567, so 1.5 billion. It's up. Not bad, but compared to last year, you see it's up a little, just a little bit, just a little bit. 6 months ended, yeah, just a little bit. It's not so much. They are. Look at the margin. The margin is basically 1567 divided by 1439. They got -1 into 100. So 8.89 the margin, right? June 30, 2025 gross profit margin is 8.89. So let's see June 2024. How is their margin? Hey, it's almost the same. Look at this, 129 divided by 1511, 8.537. Okay, just improve a little bit, 8.53 to 8.6 something. But 6 months ended, let's look at 6 months ended, 243. Wait, looks like the margin was better. The previous 6 months, 2024. Last year was better, 2024. 243 divided by 2692. So they have 9% margin. 9% margin. 227 divided by 2720, the revenue. Okay, revenue 2720. 8.34. Yeah, so they have to increase their margin. Okay, they have to increase. I think once the interest rate come down, and if they sell more houses, and their margins could improve. And plus, if you look at this, right now, June 30, 2025, it's only 13 million loss. Okay, once they have been able to eliminate this one, 13 million, and interest rate goes down. Okay, the interest expense gonna go down as well, and they're gonna go to the asset light business model. So they may not be buying, selling houses quite a lot, but again, that could bring down the revenue a little bit. So it will be interesting to see how they're gonna perform. Could they increase their revenue and margins at the same time reduce operating expenses? That will be interesting to see. I think, in my opinion, it's possible. It may not be right away. It could be 1 or 2 years down the road. But as long as they use more AI and interest rate come down, at least the stock price will be on our side. So what do you think? If you want to learn more, go to Master Risk Stock Option Crypto. Go to playlist. You can learn about stock investing, call option, put option, advanced option, day trading, movement stock. You can reach out to me. The link gonna be in the description and comment down below. Share, subscribe. I will see you in the next video. Bye bye.